I watched a founder walk into a room full of institutional investors and pitch his company at a $50 million valuation. Smart guy, great product, strong team. One of the investors asked him a simple question. How did you arrive at that number? He paused, then said, well, we think it's fair based on our potential. The room went silent. That's not valuation, that's a guess. And institutional investors will tear that apart in 30 seconds. So here's what most founders don't understand. Your valuation isn't what you think you're worth. It's what you can defend with data, comparables, and market logic that investors already use. And if you can't justify your number using the same frameworks that institutional allocators use, you've just red flagged your entire deal. So this video is going to be your complete guide to valuing a startup in 2026 and beyond. And in the next 10 minutes, I'm going to show you the 5 valuation methods that institutional investors actually use. The exact same methods that have helped close $37 billion and growing in capital across hundreds upon hundreds of deals. You'll learn how to calculate your valuation, how to defend it in investor meetings, more importantly, and the biggest mistakes founders make that absolutely destroy credibility before they ever get to terms. So by the end of this video, you'll know exactly how to value your company and how to walk into a room with confidence that your number is defensible, data-backed, and institutional grade. So let's get into it. Section 1, why most founder valuations are wrong and why it kills deals. So here's the uncomfortable truth. Most founders pick their valuation backwards. They start with how much equity they're willing to give up, work backwards to a number, and then try to justify it. I want to raise $5 million and only give up 20%. So that means I need to raise a $25 million valuation. And that's not how this works. Valuation isn't a negotiation you have with yourself. It's a market-driven number based on comparable companies, revenue multiples, growth rates, and risk-adjusted returns. And when you show up with a number that doesn't align with market reality, here's what happens. Investors immediately know you haven't done your homework. They assume you're either inexperienced or you're trying to inflate the numbers to minimize dilution. Either way, you've lost credibility, that investor's gone, and in institutional fundraising, credibility is everything. I mean, I've seen deals with $20 million in revenue die because the founder insisted a $200 million valuation when comparable companies in their sector were trading at 5x revenue, not 10x. The investor didn't even counter. They just passed. Because if you can't be rational about valuation, they assume you can't be rational about running the business. Does this make sense? These are the exact frameworks used by VCs, growth equity firms, private equity funds, and family offices when they're deciding whether to write a check. And by the end of this section, you'll know how to calculate your valuation using the same playbook. So let's get into it. Section 2, the 5 valuation methods institutional investors use. Method number 1, comparable company analysis, comps. This is the most common method and the one investors will default to if you don't provide framework. And here's how it works. You find 5 to 10 publicly traded or recently funded companies in your industry at a similar stage with similar business models. You look at their revenue multiples. If comparable SaaS companies are trading at 8x ARR and you have $5 million in ARR, your starting valuation is around $40 million. Now you adjust up or down based on your growth rate. Faster growth equals higher multiple. Your margins, better margins equals premium. Your market position, category leaders equals higher multiple. But here's the key. You can't just cherry pick the highest multiples and ignore the rest. I had a founder tell me his company should be valued at 15x revenue because one comp got that multiple. Well, I looked at the comp. It was growing 300% year over year. His company was growing 40%. That's not a comparable. That's wishful thinking. So use comps honestly because they will smell it. They will know. Investors will check your work. Method number 2, precedent transactions. Now, this is similar to comps, but instead of looking at public market valuations, you look at recent M&A transactions or funding rounds in your space. Something like 3 companies in our sector raised Series A in the last 12 months at an average of $30 million post-money. We have similar traction and comparable team experience. That's our range. Great. This works especially well in sectors with a lot of recent deal activity: fintech, AI, health tech, climate tech. The key is recency. Don't use transactions from 2019. The market has changed. Multiples have changed. Investor appetite has changed. Use deals from the last 12 to 18 months. Anything older is outdated. Okay, method number 3, discounted cash flow, also called DCF. Now, this one is a little less common for early stage startups because it requires predictable cash flows. But if you're a later stage business with real revenue and a clear path to profitability, this is powerful. Here's the concept. You project your future cash flows over the next 5 to 10 years. You discount those cash flows back to present value using a discount rate that reflects the risk of your business. Bear with me here. The sum of those discounted cash flows is your valuation. Institutional investors love this method for growth stage companies because it's grounded in financial fundamentals, not market hype. But here's the warning. If your projections are aggressive and your assumptions are weak, investors will absolutely tear this apart. I've seen founders project 500% revenue growth with no supporting data. That doesn't build credibility, it destroys it. So use conservative assumptions. I mean, if you hit your projections, great. If you beat them, even better. But don't build a DCF on fantasy. They will smell it a mile away. Method number 4, revenue multiples by sector. Different industries have different valuation norms. SaaS companies typically trade at a 5x to a 15x ARR, depending on growth rate and profitability. E-commerce businesses might trade at a 1 to 3x revenue. Biotech, deep tech might trade at a much higher multiple because the upside is exponential, but the risk is also higher. So you need to know the multiple range for your sector. And you need to know whether you fall within that range based on your metrics. If you're a SaaS company growing 100% year over year with strong retention and expanding margins, you're at the high end of the range. If you're growing 30% with high churn, you're at the low end. So don't try to argue for a premium multiple without premium metrics. Investors have seen thousands of companies. They know exactly what deserves a premium and what doesn't. You're not going to fool them. Method number 5, the venture capital method. Berkes scorecard, risk factor summation. Now, this is typically used for pre-revenue or early stage companies where traditional valuation methods don't apply because there's no revenue to multiply. Obviously, the Berkes method assigns value to key milestones. So think about it like this. Sound idea, 500 grand. Prototype, 500 grand. Quality management team, another 500K to maybe $1 million. Strategic relationships, 500 grand. Product rollout or sales, 500 grand. Add them up and you get a pre-money valuation range. It's kind of crude, but it works and it's something. The scorecard method compares your startup to the average pre-revenue startup in your region and adjusts based on strength of team, size of opportunity, product and technology, competitive environment, marketing and sales channels, need for additional funding. Now, these methods, granted, are subjective, but they give you a defensible framework for early stage valuation discussions, and that's all you need. The key is this. Even at pre-revenue, you need a method. You need a reason to talk to them. You can't just say, we think we're worth 10 million. You need to be able to say, based on the Berkes method, we've hit prototype, we have strong team, we've secured strategic partnerships. That puts us in the $2 million to $3 million pre-money range. Now that is defendable. That's institutional. So quick pause. If you're working on your valuation right now and you want to make sure your pitch deck reflects that valuation in a way that institutional investors will respect, I've already created a full walkthrough on how to build a pitch deck that gets funded. We even roast some so you know what not to do. It's one of the most watched videos on this channel and it covers exactly how to structure your deck, what goes on each slide, what doesn't go on each slide, how to present your valuation in context. And I'll link it in the description and in the card above here where you can click on it and watch it later. And if you want a free valuation calculator that walks you through these 5 methods step by step, grab that in the description below as well. Section 3, how to defend your valuation in investor meetings. Now, knowing how to calculate your valuation is half the battle. Knowing how to defend it, that's the other half. And here's what happens in most investor meetings. You present your valuation, the investor pauses, then they say, that seems high. How did you get there? This is the moment where most founders either A, get defensive and try to justify why they deserve a premium, or B, they backpedal and say, well, we're flexible on valuation. Both of those are major mistakes. Here's what you do instead. Step one, show your work. Say something like, we arrived at this valuation using comparable company analysis. We looked at 5 companies in our sector and then named those 5 companies that raised in the last 12 months at an average of 8x ARR. We're at 5 million ARR, which puts us at 40 million pre-money. We're on the higher end of that range because we're growing 120% year over year, which is faster than 4 of the 5 other comps. So what did you do? You just showed data, comparables, and logic. Now that's defensible. Step 2, acknowledge the range. Say something like, hey, we understand valuation is ultimately a negotiation, but our range is 35 million to 45 million pre-money based on these comps. We're not anchored to one number, but we are anchored to the data. Now this signals flexibility without signaling desperation. So step 3, flip it back to value creation. You could say something like, the more important question is, what milestones do we need to hit to justify a step up in valuation at the next round? Because that's what drives returns for both of us. Now you've moved the conversation from, is this valuation fair, to how do we grow this business? That's what they want to hear. That's a much better conversation to have. And here's the key. If an investor thinks your valuation is too high and they walk, that's okay. Not every investor is the right fit. If they can't see the value in your business at your valuation, they're probably not going to be a good partner when things get hard. The right investors will see the data, understand the logic, and either agree or negotiate within a reasonable range. The wrong investors will lowball you, try to squeeze terms, and create friction before you've even closed the deal. So know the difference. Okay, section 4, common valuation mistakes that red flag your deal. Let me close with the 3 biggest valuation mistakes that we see here at the firm that founders make all the time, and more importantly, how to avoid them. So mistake number 1, using outdated comps. So simple, but I see it every day. If you're using 2021 valuations in 2026, you're going to get laughed out of the room. The market has completely changed. Multiples have compressed. Investors are more disciplined, so you need to use recent comps, last 12 to 18 months. Anything older is irrelevant. Mistake number 2, ignoring your stage. A pre-revenue company cannot use the same valuation method as a $50 million ARR company. If you're pre-revenue, use the Berkus method or scorecard method. If you have revenue, use comps or revenue multiples. If you're cash flowing and profitable, use DCF. Match the method to your stage. Otherwise, you just look inexperienced. Mistake number 3, being inflexible. I've seen founders walk away from good investors because they were anchored to a specific valuation that the market just couldn't support. Valuation is important, but it's not the only thing that matters. Terms matter. Investor quality matters. Speed to close matters. If you're raising at $40 million instead of $50 million, but you're getting clean terms, a great lead investor, and a fast close, that's a win in my book. Don't let ego kill your deal. So here's where we are. You now know the 5 valuation methods that institutional investors use. You know how to calculate your valuation using comps, precedent transactions, DCF, revenue multiples, and early stage frameworks. You also know how to defend your valuation in investor meetings with data, logic, confidence, and you know the mistakes that kill credibility before you ever get to terms. But here's what most founders miss. Knowing your valuation is only valuable if you know what investors are actually looking for when they evaluate your deal. Make sense? Because you can have a perfect valuation, defensible data-backed institutional grade, and still get passed on if you don't understand what's happening on the other side of the table. So I created an entire video breaking down the 7 things all institutional investors look for before they write a check. It's one of the most important videos on this channel because it shows you how investors actually make these decisions, and they're big decisions. And here's why you need to watch it right after this video. Your valuation is just one data point in their decision framework. They're also evaluating your team, your market, your traction, your capital efficiency, and whether you understand the game that you're playing. If you nail your valuation, but you miss on those other 6 things, you're not raising capital. So go watch that video next. I'll link it in the description below and here in the card above. It's called The 7 Things All Institutional Investors Look For, and it pairs perfectly with what you just learned here. Now, if you're raising $5 million or more, we call that institutional capital, and you want someone to stress test your valuation, review your materials, audit everything you've got before you take it to market, and tell you whether you're actually ready to go to market, we can do that for you. We work with founders raising institutional rounds, upwards 20, 50, 500 million. And the first thing we do is look at your valuation, your deck, your financials, all your investor forward materials, and tell you exactly where the gaps are. Where are the holes in your bucket before you go to the investor network? Because if your valuation doesn't hold up, or if your materials don't support it, institutional investors will pass in the first meeting. So if you want an audit of your raise, no cost, no obligation, just a straightforward assessment of whether you're capital ready, book a capital strategy call using the link in the description below. We only take on anywhere between 7 to 9 clients per quarter. We're very choosy, obviously, because we have bandwidth issues and we like to work with the right clients. But if it's a fit, and if it's a good fit for you, we'll show you exactly what needs to happen to close your round. So if this video clarified how to value your startup, subscribe to the channel. I release tactical capital strategy content every week, frameworks, case studies, investor psychology from over 37 billion in closed deals from our investor network and our advisory team worldwide now. So drop your questions in the comment below. I read every single one. And thanks for watching. I'll see you in the next video.